perhaps RBI would not got a better opportunity to think of actually reversing the interest rate strategy. But the governor has been pretty conservative. So I would say the governor has adopted a good strategy of not giving any guidance, but at the same time, cutting the interest rates more from a growth inflation dynamic rather than being constrained by the exchange rate perspective. Stable rupee, if it results by way of market forces, that's a different matter. And RBI intervening to stabilize rupee is a completely different cup of tea. RBI did this entire job of stability, doesn't give a great amount of credibility to RBI in trying to hold the rupee stable at all and calling it as a stable rupee. The NDA market guys are really deep-pocketed guys. So they can actually tolerate intervention to a large extent. They can actually trap RBI in a big way. In a matter of just about 6 months to 1 year, they have dented rupee by about roughly 8 to 10%. Somewhere close to about 90 to 91 is a kind of a temporary stop for the rupee, where perhaps even from the real effective exchange rate angle, today rupee is looking fairly priced, depending upon how the Dixie is going to behave. Dixie can again move up further, again putting more pressure on the rupee.
Hello, it's an honor to introduce Mr. G. Mahalingam, a distinguished financial sector regulator with an illustrious career spanning nearly 4 decades. Mr. Mahalingam holds a master's degree in statistics and operations research from IIT Kanpur and an MBA in international banking from the UK. Mr. Mahalingam dedicated 34 years to the Reserve Bank of India, where he played a pivotal role in market operations and banking regulation. His tenure culminated in his appointment as Executive Director, overseeing the critical market functions. A key member of RBI senior management, he was instrumental in steering India's financial sector through the global financial crisis of 2008 and the taper tantrums of 2013. Mr. Mahalingam transitioned to the Securities and Exchange Code of India as a whole-time member between 2016 and 2021. His leadership at SEBI shaped regulatory policies for mutual funds, foreign portfolio investors, listed companies, and securities law enforcement. With deep expertise in both banking and market regulation, Mr. Mahalingam's insights are invaluable in navigating the evolving financial landscape. We are privileged to have him. Today, we draw on his expertise as someone who oversaw foreign exchange operations at the Reserve Bank of India for many years. Thank you, Mr. Mahalingam. I'll start the interview with a very straightforward question. Why is the rupee depreciating?
A very interesting question, actually. I think people have been coming up with several views on this. I would actually, rather than call it as rupee depreciation, I would call it as dollar appreciation, which is actually making the rupee depreciate. Now, if you look at the dollar index for quite some time now, the dollar index has been very strong, on a strong appreciation mode. So, given that the dollar index has moved considerably actually in the last about 5 to 6 months, the rupee did not make a commensurate move. Rupee was held steady by RBI for quite some time. So, I would say that what is happening now is a kind of a late resurgence on the part of the dollar against the rupee, which it has already achieved against other currencies. In fact, I was trying to calculate the percentage of dollar appreciation in the rupee. October to February, dollar index, if you see, it is appreciated by about 6%. Even at this, in the same space, October to February, rupee is depreciated only by 3.2%. So I would say that the steam is still to go. I think it is still not gone. The entire cycle is not over. Perhaps it has to move a little more. The second reason, obviously, I feel that FPA outflows. I think maybe the general investors have started feeling that the Indian share market, the stock market, has got fairly valued or slightly in the overvalued zone. So people are finding that maybe the other jurisdictions are a little more attractive. So FPAs are actually pulling out funds, and this is definitely causing the rupee to depreciate. A third factor, which is a less relatively important factor, is the interest rate differential between India and US actually. Now, GSEC currently is at somewhere around 6.8, 10-year GSEC yield. US 10-year is close to about 4.48, 4.5. So there is a gap of about 230 basis points. Now, this is again, this kind of a gap is kind of a narrowing gap, and perhaps the FPAs are feeling that it is good to take the capital out, because if you have to do a completely covered hedge strategy, investment strategy in the bonds, it doesn't fetch you anything at all these days, because the forward premium is close to about 2.2 to 2.8, depending upon the duration of the forward, and the differential being hardly about 2.3. You don't end up taking anything home at all. So, bond investment also looks on a hedge basis, doesn't look attractive. So, I would put all these factors that are responsible for rupee depreciation.
Sir, assuming that market estimates are correct and the rupee is expected to, the expectation is that it will depreciate up to 90 to 92 very soon. From keeping those levels in mind, do you think this is a cause for worry, given from an importer's perspective, from FPI's perspective, and also from a macro and financial stability perspective? Do you think a rupee depreciation at this point of time is actually a cause for concern?
Personally, when I look at it, actually, these are the kinds of situations that we face in RBI quite often. As to how do we look at it? I mean, where is the equilibrium rate of rupee on the base of REER, and where are we currently positioned? So, given that, I think if rupee touches 1992, I don't think it's a cause for a great worry at all. But then let me also slightly add a little more qualifying factors out here. There are several importers who would not have covered their positions. There are lots and lots of ECB guys who would not have covered their position. So they are going to pay through their nose that the rupee is going to swiftly move to 1992. I mean, there is a difference between rupee moving to 1992 in the next about 2-3 weeks and rupee moving to 1992 in the next about 6 months' time. So the next 2-3 weeks, if that is going to happen, it's going to cause a lot of bloodshed in the market. Lot of importers, lot of ECB guys and all. So they have to be pretty watchful. They have to maybe cover their position to some extent. Otherwise, it's going to cause some amount of tumult, some amount of bloodshed amongst those people. But from an FPA perspective, I would say that FPA is quite well conversant with these kinds of situations. So they just look for good time to exit. Already from the overvaluation perspective, they are looking at exiting the market. All that they are trying to do now is a bit of a timing as far as the currency is concerned. So for them, really, it does not matter if it moves to 1992, because any kind of upshots in rupee, they would really look for opportunities to exit. From a macroeconomic perspective, I would definitely say it's going to be good if the rupee is going to depreciate to 1992, because ultimately, I for one, I believe that at some point of time, rupee should be closer to the equilibrium rate. Now, you can ask me the question, I mean, what is the equilibrium rate? Is it good enough as it is determined by RER model and all? I know there are a lot of assumptions as far as RER model is concerned, but nevertheless, I think that model has stood us in good stead for quite some time now. So while we may not treat it as an absolutely rigid goalpost, it is still good to work with that kind of an approximate goalpost. So from a macroeconomic perspective, while this may suffer some dent if rupee is going to touch about 92 in a very short period of time, I think the government better get used to the fact that the rupee is going to move towards that area, and it is better that it moves and the oil prices are very benign. The oil prices are actually moving the other direction, moving towards about $70. So it is the best time for the government also to think that if the rupee depreciates by another about, say, 3-4 rupees, it's not going to cause a huge dent on their balance sheet.
So there is, while most people in the market were expecting the RBI to cut interest rates, and it has cut interest rates, those who were cautioning against an interest rate cut were worried about the rupee's depreciation and suggested the RBI holds on for some more time. In this context of the exchange rate, do you think the RBI was right in cutting interest rates at this point of time? What they did in one Fed 7th?
Yeah, that's again a excellent question, Kalyan. Actually, the thing is, looking at it pretty dispassionately, I mean, not associating myself with RBI, I would definitely say from a textbook perspective, from a general reasonable expectations perspective, RBI did an excellent job of cutting the exchange rate, cutting the interest rate. Now, cutting the interest rate is purely a function of growth inflation dynamics. In fact, RBI does not look at the exchange rate in a big way when it has to operate the monetary policy. The monetary policy balances between the growth requirements of the economy and containing the inflation requirements of the economy. We are situated at such a position where perhaps the growth needs to be propped up, the growth needs to be given a lot more support when the inflation is perhaps a little benign right now. Inflation doesn't seem to be showing signs of surging. So perhaps RBI would not got a better opportunity to think of actually reversing the interest rate strategy. But the governor has been pretty conservative. The governor has been pretty prudent in not actually giving a kind of a guidance to the market that he is going to cut the interest rates by another 50 basis points, 75 basis points, because that only the incoming data would reveal. So I would say governor has adopted a good strategy of not giving any guidance, but at the same time, cutting the interest rates more from a growth inflation dynamic rather than being constrained by the exchange rate perspective.
So there is one more aspect that the market keeps talking about, especially when there is a very dynamic movement in the exchange rate, is that they say that the exchange rate is a release valve. Whenever there is pressure building up from a financial stability standpoint or from a macroeconomic instability standpoint, it gets reflected much before anywhere else in the exchange rate. So, uh, although you said that the rupee's fall is more of a dollar appreciation than a rupee depreciation, do you still think that it is reflecting some sort of problem with regard to how Indian economy is shaping up at this juncture?
This is again, I would put Kalyan is a very good question. The thing is actually the macroeconomy of India, I would say that it's in a reasonable shape. I wouldn't say it's an excellent shape, but it's definitely not in a bad shape right now. So to call this as a kind of a release phenomenon, just a balancing phenomenon, I may not really agree. But let me look at it slightly the other way. Uh, the previous governor, I think he held on to a pretty stable exchange rate. So there was a lot of accumulated pressure on depreciating rupee, which was actually halted by RBI's constant intervention. When the dollar Dixie was actually appreciating and the rupee was not allowed to depreciate to that extent, I think there was a kind of an accumulated pressure. So I would say that pressure is getting released now rather than any macroeconomic fundamental dent which is giving way right now.
I was actually going to come to this question about the previous RBI governor and his plan of keeping the rupee rock steady. And subsequently, you must have read there were a lot of speculation with if RBI was actually pegging the rupee's exchange rate to the dollar. So, to that extent, what do you think was the game plan? If you recall, the previous governor had mentioned that a stable rupee is something that the RBI was looking for, and he also said that the RBI will continue to accumulate reserves. So this was said in the April monetary policy. What was the game plan according to you that RBI took this approach?
I have a feeling that maybe definitely the RBI governor was looking forward to a stable rupee. But I would say a stable rupee, if it results by way of market forces, that's a different matter. And RBI intervening to stabilize rupee is a completely different cup of tea. And RBI did this entire job of stability, doesn't give a great amount of credibility to RBI in trying to hold the rupee stable at all and calling it as a stable rupee. Because you deliberately held it stable and calling it as a stable rupee doesn't root too much of a credit at all. Personally, I feel that this stable rupee helped, number one, to hold the government fisc in shape. Number two, to hold the inflation in shape when the inflation actually could have gone all over the place when the developed economies are facing huge amount of inflation pressures. So I thought maybe that was a plan with which it was actually held pretty stable. I would actually say that that strategy has boomeranged subsequently.
Uh, do you think there was also one speculation that the RBI may have done it with to help companies which were either going overseas to raise some external commercial borrowings or had to repay external commercial borrowings. So to that extent, it was felt desirous to keep the exchange rate stable. Do you think RBI functions like this? This is one speculation which is there in the market or in in academic circles that RBI may have done this. So, from your experience, do you think RBI looks at these aspects?
No, certainly not, Kalyan. RBI would not look at these kind of one small aspect of the overall external sector and to protect that sector, external part of the external sector, RBI would have done this. I don't believe this at all. Because RBI all said and done looks at the broad macroeconomic perspective. And it would like to operate in a way that it doesn't actually favor one particular sector, one particular entity or exporter or importer, anything in particular. You could like to balance out all the factors. So, given that, I don't think there is any kind of a bias in the mind of RBI to favor the ECB guys, actually.
Uh, Sir, do you also think this is again dealing with conjectures and some some bit of analyzing why RBI chose to keep the rupee rock steady and not let it move? Uh, was the RBI also preparing for some sort of repeat of taper tantrums when Fed moved its interest rate starts? Was something like that expected, and to that extent, the RBI was on a reserve accumulation drive?
Yeah, this also is a very important question. In fact, RBI always has its mind a kind of a stable rupee. But a stable rupee does not mean a nominal value stable rupee at all. So I thought that way, perhaps whatever was done by the previous regime was in terms of a nominal value stable rupee. That did a little more harm actually in terms of accumulated pressure. So while taper tantrum kind of an episode is always at the back of the minds of RBA that any time there could be a speculative attack on the rupee and the rupee will give way and that could be a vertical fall, RBA would always like to guard against these things. But that doesn't, I mean, it cannot be prevented by holding the rupee stable on a nominal value basis at all. So clearly, I think what was aimed at the point of time, while taper tantrum there was, I mean, kind of fears would have been at the back of the mind. The strategy was not that kind of a strategy which was succeeded against that kind of a speculative attack.
Sir, I would like to now go into aspects of a little more detail about how interventions happen and how the RBI's toolkit for intervention at this point of time. But before that, the new RBI governor mentioned that he is not looking at day-to-day changes in the exchange rate. He looks at a slightly more broader trend. But even before he made that statement of the latest monetary policy, there was evidence that the rupee was moving quite a bit, and the RBI was happy to let it move significantly. But suddenly, 2 days after the monetary policy, we keep hearing that the RBI may have intervened anywhere between $10 billion to $15 billion over a span of 1 to 2 days. And maybe it has continued to sell last week to keep the rupee, to stabilize the rupee. What do you think must have happened before the MPC statement and after the MPC statement that the rupee suddenly there was this huge intervention in the market by the RBI?
Yeah, again, I'm not sure how much RBI has intervened, but I also been hearing about a large volume intervention having been done by RBI during this particular period. Now, one thing is that while I'm going to answer this, it may not look scientific at all, but this is RBI something which takes into account. There are round sum numbers which RBI is definitely going to protect. So when you talk about 90, when you talk about 80, 90, 100, I think these are psychologically very important numbers. While rupee started rapidly moving towards 87, in the same momentum, if it had gone to 90, one great barrier would have been breached. And then to get it back from 90 would have required a Herculean kind of a battle. So what now RBI is actually doing is kind of fighting a war, trying to protect that 90 barrier. So that 90 barrier being psychological, I think they want to protect it at paying some cost for it actually. The cost could be, I'm not sure whether it is 10 or 12 or 15 billion, but they want to protect it for some time. But I would say that this protection is not going to be an indefinite kind of a protection at all. This is only a psychological protection because once it crosses 90, getting back on the other side of 90 becomes virtually difficult. And then going on the other side of 90, the whole market starts speculating on. And RBI's job is rendered very, very difficult. So instead of ending up spending about $25, $30 billion after it crosses about 90, they thought that let us prevent that 90 psychological barrier for as long as possible, maybe for 2 months, maybe for 3 months, maybe for 6 months. After that, let it cross. Perhaps that's a strategy that I think, because we also used to have these kinds of nightmares of the round sum numbers getting crossed.
So, do you think the market had actually taken advantage of RBI, allowing it a little bit more play to actually build up speculative positions? To that extent, the RBI was forced to intervene very heavily.
There is a possibility of market. One thing about this market is there are some players who definitely take advantage of these kind of speculative positions. And there are some people who actually shed a lot of blood because of RBI's intervention. Both things happen. So my feeling is, in such a swift, drastic move, certain people would have definitely made a huge amount of money and they would be laughing all the way to the bank. And there are some people who would have definitely had their unhedged position, particularly the importers and all. They would be really paying through their nose. So these kinds of possibilities are always there. But while RBI tries to guard the real user of the economy from huge falls in the rupee, not all the time RBI would be able to succeed, because these kinds of speculative attacks, when it takes place, RBI cannot spend endlessly from its coffers. So at that point of time, I think perhaps RBI lets it go to some extent, then again steps in, then lets it go. That kind of a stop go kind of an approach RBI would adopt.
So, I would also would like to ask you about the fact that RBI has started intervening in the non-deliverable forward market. I want to understand, how do you see this aspect as opposed to the interventions in the forward market or interventions in the spot market? Is NDF, and also there is this concern about RBI building up large forward positions, and that creating some, I mean, that has been speculated by the market, that could create some challenges for the RBI in the future. So, how do you see from an intervention standpoint the new aspect in the toolkit, which is the NDF market, and also RBI running huge forward positions? So, from a game plan or strategy perspective, how do you view this?
This is again a pretty good question, because one thing is RBI has started using the NDF market as a part of its toolkit only very recently, just about a couple of years back. In my view, this is a very, very useful toolkit, because a good lot of speculation actually comes from, it is actually emanates from the NDF market. But when RBI, as you rightly, framed your question, the NDF market guys are really deep pocketed guys. So they can actually tolerate intervention to a large extent. They can actually trap RBI in a big way. That's what their pockets are really huge enough to do that. But at the same time, we got to again realize the fact that when RBI intervenes in the NDF market, RBI does not really deliver the sold dollars out there. Whereas here, most of the sold dollars are delivered. Maybe some positions are neutralized. NDF market is completely and completely a cash settled market. So even if RBI intervenes to the extent of about $20-25 billion in the NDF market by way of selling a huge amount of dollars, which could actually hurt the speculators in a big way. Net, if the rupee is going to move the other way, RBI will end up paying the dollar equivalent of only the cash difference between the two rates. So to that extent, RBI's coffers of foreign exchange reserves would not get dried up to the extent that it would get dried up by intervening in the domestic market. So that is one distinct advantage of being in the offshore market, building up forward positions in the NDF market. But at the same time, NDF market is a kind of a, it has a colossal amount of speculative pressure. So when RBI enters it, RBI will have to be a little more cautious, a little more prudent. It has to do a lot more talking to at least some of the Indian banks operating there, just to understand what kind of forces are operating in the market and to take very cautious moves. But then those moves in magnitude terms are going to be much larger compared to magnitude terms to the domestic market. Nevertheless, the dent on the foreign exchange reserve coffers will be much less compared to the domestic market in the offshore market. But the dent on profitability of RBI is going to be significant if the forward positions run into losses in the NDF market. But let's again look at it from the other perspective. RBI, all said and done, is a kind of a quasi-sovereign. And RBI intervenes on the perspective of bringing about macroeconomic stability as far as the currency and interest rates are concerned. So if that does involve some cost, RBI should not be bothered too much about the cost aspect there.
So, one related question to this intervention in NDF market is that if the RBI fails to make a big impression in the NDF market, is it more riskier, that is fraught with more danger, that RBI will expend, even from a contract value perspective, a huge amount of money, but not make an impression in the market? And that adds to more speculation with the market trading jabs with the central bank. Is that, in that sense, a little risky given the play in the NDF market?
Absolutely, Kalyan. It is a risky venture, no doubt about it. But then we can't discard the toolkit just because it is risky. I completely agree with you. A failure of RBI in the LDF market will be viewed by speculators as a real great victory for them compared to the domestic market. Because the domestic market is made up of end users also, a good number of end users who are actually consuming the dollars, who are actually using the dollars, either selling or buying. Whereas the NDF market is more of speculators. For a speculator driving a kind of a victory signal, deriving a victory signal from there would actually encourage them to play around more with a greater amount of speculation out there. That risk is very much inherent in the NDF market.
So, I'll move to one hypothetical question. If you were still the chief dealer of RBI, uh, what would you advise the brass at this point of time in terms of a toolkit?
Well, my strategy would have been, even at that point of time, it was such that whenever such attacks take place, I think we need to yield to that attack to some extent. We can't allow the rupee to fall vertically. It's going to be very injurious for the rupee to fall vertically. But at the same time, we can't hold the rupee on our shoulders at any cost. That's going to cause more damage to the foreign exchange reserves, liquidity, all those things actually. So we need to it's easier for me to say, but for practicing, it's going to be difficult. You have to be there in the market. You have to be missing from the market. You have to be present in some doses all the time. And you have to still be unpredictable in the market. Now, these are things which are going to be very, very difficult to define by way of a sharp parameter. To the extent that you become a little more unpredictable as far as the market is concerned, the market is left guessing what the RBA is going to do. Now, I'm not saying whatever the RBA is doing currently is totally wrong or totally right, because at any point of time to brand a strategy as completely wrong or completely right, it's going to be very difficult at that point when the strategy is practiced. From the hindsight, you can always pass a value judgment on that. So I have the benefit of the hindsight today, that I can sit in hindsight and pass a value judgment. But if I were to be sitting there, I know I'm beset by several forces, pressures, speculative attacks, and all that. I need to make up my mind quickly. So I would say, on the whole, a kind of a balanced intervention, not being present, not being absent, but being unpredictable, is going to be a very important strategy. Don't really, be extravagant with dollar spending. Don't be very constrained with dollar spending also, but adopt a kind of a mid-course strategy.
So, one obvious questions which most people who are users of foreign exchange would want to know is where where does one think the exchange rate is going to actually stabilize in the near term? Would you want to make a case given what Fed has been doing, given the global scenario with regard to tariffs, etc.? Where do you think in the next 6 months is a reasonable bet where RBI would also be to some extent open to, or would allow the rupee to settle at?
See, again, this is going to be a very difficult thing for me to predict actually, because the thing is, a multitude of forces act upon the rupee. It's not the domestic forces alone or the RBA alone. We have Trump there doing all kinds of things actually. So that could actually, put a lot of pressure on the rupee. So we can't really say where the rupee is going to be positioned. But let me take a bet on that, because I have seen the rupee moving in jerks from 31.37 to about 37.38, from there jumping to about 43, from there jumping straight to about 50, 55 zone. It was pretty stable. Then Raghuram Vajan came and then it jumped all the way to 68 actually. Then it again retraced backwards. Again, now the depreciation kind of a bout has started. So many of these depreciation bouts, if you look at in percentage terms, they have actually been, in a matter of just about 6 months to 1 year, they have dented rupee by about roughly 8 to 10%, which is very substantial. So that same 8 to 10% measure, if you are to take from say about 80 onward, I would definitely say somewhere close to about 90 to 91 is a kind of a temporary stop for the rupee. Where perhaps even from the real effective exchange rate angle today, rupee is looking fairly priced, depending upon how the Dixie is going to behave. Dixie can again move up further, again putting more pressure on the rupee. But right now, I would say that the whole thing would stop somewhere close to about 90, 91, even from psychological barrier.
That's interesting aspects. Uh, uh, One more topic which of discussion has been the push in the last several months for internationalization of the rupee.
Yeah.
Uh, what do you think about this particular game plan? And has that changed the exchange rate management to some extent in the last one year? This drive or this approach towards rupees internationalization, was that an added factor to keep it really rock steady?
Let me actually evaluate it from a perspective of medium to long term. Now, what Reserve Bank did, at least one significant aspect I would like to discuss here is about the rupee settlement, actually, which has been introduced for Russian debt and all that, Russian oil purchases and all that. Yes, certainly to that extent, our coffers did not dwindle in terms of dollars being paid out for oil. But then let us look at it slightly from a longish term perspective. Now, unfortunately, what we thought was all the dealings with Russia will be only in rupee terms, and the Russian Vostro accounts are now overflowing with rupees. Now, what are they going to do with that rupee? This is going to be a very big question. I mean, Russia is not going to be a mute spectator to the rupee accumulation in the Vostro account at all. They would like to either, invest it in Indian government bonds, whether India would permit that much of investment, Russian investment to come in government bonds, and whether the long-term bonds, medium-term bonds, or the far route, that fully accessible route will be further opened for Russian investments there is something that we need to very seriously think. Otherwise, Russia is going to be peeved with this kind of a opening, which doesn't allow it to invest in the rupee bonds. At the same time, if it wants to take the rupee back, there is no way that it can utilize it at all. So they would like a hard currency in exchange for the rupee. Now, if they are going to ask for hard currency in exchange for the rupee, the entire original strategy of trying to do rupee settlement gets defeated. So we have to look at it from a medium to long term perspective. So I would say this kind of a rupee settlement for a country like India would work for only those countries where we have a reasonable balance of trade, perfect balance of trade, near about zero. There it can work very well. Where the other counterparty countries are running huge amount of surpluses, we are going to have a huge amount of Astro rupee accumulation. And if we don't open up investment avenues in India, I'm not talking about foreign direct investment. Foreign direct investment is a different cup of tea. I'm talking about portfolio investment in terms of investing in Government of India securities, state government securities, corporate bond, any other alternative investment funds and all that. If we don't open up this, I think eventually this scene is not going to be successful. So my feeling is internationalization of rupee will have to actually look at a vision which is going to be for the next 10 years, 15 years. It can't stop at just about 2 years. Fine. It has helped in arresting the use of foreign exchange reserves for the last about 2, 3 years. But what is going to happen in the future, next 5 years, next 10 years? That I think the Reserve Bank will have to plan very carefully sitting with the government.
Now, moving on to related aspects, the RBI, I'm coming to RBI's liquidity framework. Given the recent currency volatility and then the tightness that we've seen in the recent past, do you think the current liquidity framework uh, is working, or do you think the RBI needs to review its liquidity framework and then maybe have more overnight operations to balance liquidity?
Here, actually, liquidity is a subject on its own. This one, I think it requires at least about half an hour, 1 hour to discuss a liquidity framework itself. But let me put it in a very summarized version. At some point of time, I think we in Reserve Bank, we thought about a liquidity framework which addresses the structural liquidity needs and the transient liquidity needs. That's the frictional liquidity needs. Structural liquidity needs is as the GDP keeps going up, you need certain amount of liquidity from the RBI to support that kind of a GDP. That's a structural liquidity need, which means if GDP is going to expand by say about 8%, 9%, how much of the currency expansion took place? How much of primary money, reserve money that Reserve Bank will have to introduce in the system is one calculation which is done by RBI in the base of econometric modeling. Now, that structural liquidity, as long as RBI feels that the GDP is expanding at the pace at which it has estimated, RBI should not be constrained in giving that liquidity to the system at all. This is the most important, I think, underlying framework in any liquidity system. If we are trying to be constrained just because we want to control inflation, so we say that we won't give even this liquidity on a structural basis, on a permanent basis, we would tend to give this only on an overnight basis. No, this will not work at all. Overnight basis liquidity should be purely and purely a frictional liquidity kind of thing. There is a lot of accumulation of cash balances because taxes are paid and the government balances are kept with RBI. Till the government spends, that is a kind of a frictional liquidity shortage. This frictional liquidity shortage can be addressed by way of short-term liquidity injections. But certainly, structural liquidity gaps cannot be sought to be addressed by short-term liquidity injections. I'm putting it in a summary way, but there are a lot of things that we need to look at when it comes to liquidity.
So one final question from my side. You welcomed the RBI's repo rate cut earlier this month, but one counterpoint has been that the RBI monetary policy works more or is more effective when it is countercyclical. So that to that extent, the fiscal policy has been very tight, and the monetary policy has been tight thus far. But there seems to be a tendency or a preference for the government to lean on the RBI at this point of time to help with growth. It was expected that the government will loosen its purse, maybe undertake more revenue expenditure, because capital expenditure, the absorption has not been that great. So, do you think that in that sense, the reliance on monetary policy to revive growth, will it really work? Will it really help?
Yeah, there is also a very important question. I completely agree with you. Government totally depending upon RBI's monetary policy to actually give a push to growth may not really succeed. But then I would like to look at it from the government's perspective also and give full credit to the government in the way it is handling the fiscal thing right now. Now, I don't think the government wants FIS to go completely berserk in pursuit of growth. They are trying to encourage the private sector to step in with a huge amount of capital investment. But then the private sector is reluctant to come in till the government actually shows the way. So it has become a chicken and egg kind of a situation. So what the government perhaps would like to do is it would like to actually do a bit of capital expenditure, which it is trying, which it is actually budgeted to some extent also, although not to the extent that perhaps the market expected. But beyond that, they are a little skeptical that it would actually damage the FIS. They would not be able to go towards a target of about 4% in a shortest possible time. So they are trying to hold the reins and at the same time try to do capital expenditure up to the extent possible. Because there is another thing that the government is going to be bothered by. Now, government is bothered by the rating agencies also. The rating agencies are looking at the fiscal deficit actually. If the fiscal correction is going to come through as the government is very keen and intent on that, perhaps we could get a rating upgrade. And that could actually be a game changer as far as the country is concerned because there could be a lot more money flowing in and all that. So the government is looking at that perspective, doesn't want to loosen the fiscal at all. So at the same time, if there is a leeway available in the monetary policy side, what the government wants is exploit the leeway to the best extent possible. That's what they are trying to do. So I'm not too sure whether I'm not saying that the government is trying to be irresponsible. I'm saying that the government is trying to be very responsible, trying to balance between the amount of capital expenditure that they can do, which can cause a dent to the FIS, vis-a-vis what monetary policy can achieve with the room available, actually.
So, to that extent, do you think there will be more room available for monetary policy to do its part to support growth in the
Actually, it's going to be a little difficult for RBI to go further till the incoming data reveals that the inflation is coming down. If the incoming data is going to end up showing some softening inflation, RBI will have a little more room to actually travel. But then otherwise, the room is not great. But strategy also matters here. Actually, if RBI is going to say that I'm cutting the rate and if they are going to change the stance, it makes a huge difference to the market actually.
Mr. Mahalingam, thank you so much for your time and all the insights that you offered us today. Thank you.
Lord Kalyan, very good question. Thank you.
Thank you.
Thank you.